What if I told you that while everyone's debating stocks versus bonds, there's a metal sitting in vaults around the world that's become the ultimate escape hatch from a financial system that's quietly unraveling? Not gold, silver. And the reason why might shock you, because it's not about what silver is worth right now. It's about what happens when the paper promises can't be kept anymore. Let me paint you a picture of what's actually happening behind the scenes. Right now, as you're watching this, there's a structural deficit in the silver market that's been building for years. We're not talking about a temporary supply hiccup. We're talking about industrial demand consuming more physical silver than mines can produce, year after year, while investment demand is simultaneously surging. The Silver Institute reported that total demand has been outstripping supply, creating a deficit that's draining above-ground inventories at an alarming rate. Think about that for a second. The world is literally running out of available silver while demand keeps climbing. But here's where it gets interesting. Silver isn't just some shiny metal people collect. It's absolutely critical to the modern economy in ways most people don't realize. Every solar panel requires silver. Every electric vehicle uses significantly more silver than traditional cars. 5G infrastructure, medical devices, water purification systems, electronics in everything from your smartphone to military equipment. Silver is irreplaceable in these applications because of its unique properties. It's the most conductive metal on Earth for both electricity and heat. You can't just substitute it with something cheaper when it runs out. Now, while industrial users are scrambling to secure supply, something else is happening that should make your ears perk up. Central banks around the world have been on an unprecedented gold buying spree, adding hundreds of tons to their reserves. But here's what they're not advertising. This isn't just about diversification. This is about preparation. When central banks in China, Russia, India, and across the BRICS nations are accumulating physical precious metals at record pace, they're sending a signal. They're building lifeboats while telling everyone else the ship is fine. And before we go further, I want to make sure you have access to something valuable. I've put together a free guide in the description below that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It's completely free, and if you're concerned about what's coming, you'll want to grab that. Now let's talk about what makes silver different from every other asset you might be considering. Gold gets all the headlines. Gold is the traditional safe haven. But silver? Silver is gold's volatile younger brother, with a chip on its shoulder and something to prove. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically around 15 to 1 when you look at what's actually in the ground. But right now, that ratio has been wildly out of whack, sometimes reaching levels that make absolutely no sense from a fundamental standpoint. Here's why that matters. When that ratio is stretched, it means silver is undervalued relative to gold. And when it snaps back, which it always does eventually, silver doesn't just catch up, it explodes. We saw this in the early 80s when silver went parabolic. We saw it again in 2011 when silver nearly touched $50 an ounce. And each time the move was violent and fast, catching most investors completely off guard. But let me tell you what's different this time. Back in those previous silver surges, we didn't have the industrial demand we have now. The green energy transition wasn't a thing. Electric vehicles were golf carts. Solar panels were experimental. The world wasn't trying to build out entirely new infrastructure that's absolutely dependent on silver. This time you've got investment demand and industrial demand competing for a shrinking pool of available metal. It's like musical chairs, except the music's about to stop and there aren't nearly enough chairs. Let's dig into the supply side because this is where things get really interesting. Silver mining isn't like flipping a switch. You can't just decide to produce more silver when the price goes up. Most silver, about 70%, comes as a byproduct of mining other metals like copper, lead, and zinc. That means silver production is tied to the economics of those other metals. Even if silver prices double, if copper prices are down, those mines might not be profitable to operate. You're stuck. And here's the kicker. The easy silver has already been mined. The high-grade deposits that made mining profitable at lower prices, they're depleted. New discoveries are rare. The ore grades are declining, meaning you have to move more rock to get the same amount of silver. Production costs are rising. Energy costs are rising. Labor costs are rising. Environmental regulations are getting stricter. All of this means that even at higher prices, bringing new supply online takes years and massive capital investment. The supply response is slow and limited. Meanwhile, on the demand side, you've got this perfect storm brewing. The solar industry alone is projected to consume massive amounts of silver in the coming years as countries race to meet climate goals. Each solar panel uses about 20 grams of silver. Multiply that by billions of panels being installed globally. Then you've got electric vehicles, which use about twice as much silver as conventional cars. The EV revolution isn't slowing down. It's accelerating. 5G networks require silver. Data centers require silver. The electrification of everything requires silver. But wait, there's more. Investment demand is waking up. For years, silver was ignored. It was boring. It went nowhere while tech stocks and crypto grabbed all the attention. But something's changing. People are starting to realize that the financial system has some serious cracks. Government debt levels are astronomical. Central banks have printed more money in the last few years than in the previous century combined. Inflation isn't transitory, no matter what they called it. Real inflation, the kind you feel at the grocery store and the gas pump, is eating away at purchasing power. And when people lose faith in paper currency, they don't run to other paper assets. They run to things that can't be printed, things that have held value for thousands of years, gold and silver. But here's the thing about silver that makes it the better play for most people. Gold is expensive. 1 ounce of gold costs thousands of dollars. That's a big barrier to entry for average investors. Silver? You can buy an ounce of silver for a fraction of that. It's accessible. It's affordable. And when the rush starts, when regular people start trying to get their hands on physical metal, silver is what they'll buy. Now let me tell you about the paper silver market, because this is where things get absolutely wild. The COMEX, the commodities exchange where silver futures are traded, has a fascinating relationship with physical silver. On paper, massive amounts of silver trade hands every single day. Contracts representing millions of ounces change hands electronically. But here's the dirty little secret. Most of those contracts never result in physical delivery. They're settled in cash. It's paper trading paper. The problem is, this creates a situation where the price of silver is being set by paper contracts that have only a tenuous connection to actual physical metal. It's like having 100 people holding tickets to the same airplane seat. It works fine as long as only one person shows up to claim it. But what happens when everyone shows up at once demanding their seat? Chaos. We've already seen glimpses of this. There have been moments when premiums on physical silver coins and bars spiked way above the spot price. Times when dealers were completely sold out. Times when the disconnect between paper price and physical availability became glaringly obvious. And each time, the system managed to paper over the cracks and keep going. But the cracks are getting bigger. Here's what keeps me up at night. The total amount of physical silver available for investment is shockingly small. When you subtract industrial inventory that's already spoken for, when you subtract silver that's in jewelry or other forms that won't come back to market easily, you're left with maybe a couple billion ounces of investment-grade silver in the entire world. That sounds like a lot until you realize that's less than 1 ounce per person on Earth, and it's a tiny fraction of the total financial assets sloshing around the global economy. If even a small percentage of global wealth tried to move into physical silver, there simply isn't enough to go around at current prices. The price would have to rise dramatically to ration the available supply. We're talking about a market that's so small that a few $1 billion of buying pressure could move the needle significantly. Compare that to the bond market or the stock market where trillions of dollars trade daily. Silver is a minnow in an ocean of liquidity. And this brings us to the real reason why physical silver is the only real exit. Not silver ETFs, not silver mining stocks, not silver futures contracts, physical silver. Metal you can hold in your hand. Because when the system is under stress, when there's a crisis of confidence, paper promises have a nasty habit of not being kept. Think about what happened in 2008. Lehman Brothers had paper that said they were good for the money. They weren't. Bear Stearns had paper. Didn't matter. When confidence evaporates, counterparty risk becomes everything. Who's on the other side of your trade? Can they actually deliver what they promised? With physical silver in your possession, there's no counterparty risk. You own it. It's yours. Nobody can default on it, freeze it, or claim it doesn't exist. This is why central banks hold physical gold, not gold ETFs. This is why the smart money, the really smart money, is accumulating physical metal. They understand that in a crisis, possession is everything. The old saying, possession is 9/10 of the law, becomes literally true when the financial system is wobbling. Now, I know what some of you are thinking. This sounds extreme. This sounds like doom and gloom. But I'm not saying the world is ending tomorrow. What I'm saying is that the risk-reward equation has shifted dramatically. The downside of owning physical silver is limited. It's a tangible asset with industrial demand. It's not going to zero. But the upside is enormous if even half of what I'm describing plays out. Let's talk about what a real silver squeeze would look like. Because we've never actually seen one in the modern era. We've seen price spikes. We've seen short squeezes in the futures market. But a true physical shortage where industrial users can't get the metal they need, that would be unprecedented. And it would force prices to levels that would shock people. Imagine solar panel manufacturers bidding against electronics companies, bidding against investors for available supply. Imagine mints unable to produce coins because they can't source enough silver. Imagine premiums on physical metal going to 50, 70, 100% over spot price because spot price becomes meaningless when you can't actually buy metal at that price. This isn't fantasy. This is what happens when you have inelastic demand meeting constrained supply. And here's the thing about industrial users. They can't just stop using silver. A solar panel company can't say, well, silver's too expensive, let's just not make panels this year. They have contracts, they have obligations, they have to have the metal, so they'll pay whatever it takes. And when industrial users start panic buying to secure supply, that's when things get really interesting for people who already own physical silver. But let's zoom out for a second and talk about the bigger picture, because silver doesn't exist in a vacuum. What's happening with silver is happening against a backdrop of massive monetary and geopolitical shifts. The dollar's role as the world's reserve currency is being challenged in ways it hasn't been since Bretton Woods. The BRICS nations are actively working on alternative payment systems. They're settling trade in local currencies. They're accumulating gold and reducing dollar reserves. This isn't conspiracy theory. This is openly stated policy. China and Russia have been very clear about their desire to reduce dependence on the dollar-dominated financial system. And they're not alone. Countries around the world are watching what happened when Russian dollar reserves were frozen and thinking that could be us. So they're diversifying, they're building alternatives, they're preparing for a world where the dollar isn't the only game in town. What does this have to do with silver? Everything. Because when confidence in fiat currency declines, when the monetary system is in flux, precious metals become the ultimate neutral asset. They're nobody's liability. They're not dependent on any government's promise. They're just metal, and that makes them valuable in a way that paper can never be. Now, speaking of protecting wealth, if you're sitting on retirement accounts worth $100,000 or more, you need to understand how gold IRAs work. I've put together a comprehensive guide that covers how to get physical gold into your retirement account without tax penalties. It's in the description below. This is about having options, about not having all your eggs in one basket, especially when that basket is denominated in currency that's being printed into oblivion. It's worth checking out if you're serious about protecting what you've worked your whole life to build. Let me tell you a story that illustrates why physical matters. Back when the Hunt brothers tried to corner the silver market in the late 70s and early 80s, they accumulated massive positions in silver futures. On paper, they controlled billions of dollars worth of silver. But when the exchanges changed the rules, when they implemented position limits and raised margin requirements, the Hunt brothers were forced to liquidate. Their paper positions evaporated. If they had held physical silver instead of futures contracts, the outcome would have been very different. The rules can change, the game can be rigged. But physical metal in your possession, that's yours, regardless of what rules they make up. This is the lesson that gets forgotten in bull markets and remembered in crises. When things are going well, paper claims seem just as good as the real thing. They're more convenient. They're easier to trade. They don't require storage. But when things go sideways, when there's a scramble for the exits, paper and physical diverge dramatically. And the people holding paper find out the hard way that their claim on metal isn't the same as actually having the metal. We're seeing early signs of this divergence already. Premiums on physical silver coins and bars have been elevated for a while now. Delivery times from mints have been extended. Dealers are having trouble keeping inventory. These are yellow flags. Not red flags yet, but yellow. They're telling you that the physical market is tighter than the paper price suggests. And when those yellow flags turn red, when there's an actual shortage, it'll be too late to get in at reasonable prices. Let's talk about what happens in different scenarios, because I want you to understand the asymmetry here. Scenario 1, I'm completely wrong. The financial system is fine. Inflation gets under control. Everything goes back to normal. What happens to your physical silver? Well, you still own a tangible asset with industrial demand. Silver isn't going to zero. You might not make a fortune, but you're not wiped out. You have insurance that didn't pay out, but you still have the insurance. Scenario 2, things muddle along. Inflation stays elevated but doesn't spiral out of control. The dollar weakens gradually. Debt keeps growing. In this scenario, precious metals do well as a hedge. Your silver appreciates, probably outpacing inflation. You're preserving purchasing power while a lot of other assets struggle. Scenario 3, things get ugly, real ugly. Confidence in the currency collapses. There's a rush to hard assets. The paper silver market breaks down. Physical silver becomes nearly impossible to find at any price. In this scenario, your physical silver isn't just an investment, it's a lifeline. It's wealth preservation at a level that most people can't even imagine, because they've never lived through a real currency crisis. The beautiful thing about physical silver is that it performs in all three scenarios. It's not a binary bet. It's not all or nothing. It's asymmetric. Your downside is limited. Your upside is enormous. And in the worst case scenario, it's exactly what you need. Now let me address something that comes up a lot. People say, but silver's been a terrible investment for years. It went nowhere while stocks went up. And you know what? They're right. Silver has been frustrating for a long time. It's been range-bound. It's been boring. But here's what you need to understand. Markets don't move in straight lines. They go through long periods of consolidation, followed by explosive moves. Silver is a coiled spring. The longer it consolidates, the more energy builds up. And when it releases, it's violent. Look at the chart of silver over the last 50 years. It's not a steady climb. It's long periods of nothing, followed by vertical moves that happen so fast you can barely react. The people who make money in silver are the ones who position before the move, not the ones who chase it after it's already happened. And right now, with everything I've described, with the supply deficit, with the industrial demand, with the monetary instability, with the geopolitical shifts, we're setting up for one of those moves. But here's the critical part. You can't wait until it's obvious. When it's obvious to everyone, when silver is on the front page of every financial publication, when your neighbor is talking about it, it's too late to get in at good prices. The time to position is when it's still boring, when people are still skeptical, when the mainstream is still ignoring it. That's when the smart money accumulates. And make no mistake, smart money is accumulating. You can see it in the data if you know where to look. Coin sales from major mints have been strong. Premiums have stayed elevated. Large bars are moving from COMEX warehouses. This is quiet accumulation. This is people who understand what's coming, positioning themselves before the crowd figures it out. Let me tell you what I think the trigger will be. I don't know exactly when it'll happen, but I know what it'll look like. It'll start with a shortage in one part of the market. Maybe industrial users can't get the silver they need. Maybe a major mint runs out of inventory. Maybe there's a delivery default on COMEX. Something will break the illusion that paper and physical are the same thing. And when that happens, when the market realizes that there's not enough physical silver to satisfy all the paper claims, that's when panic sets in. That's when the scramble starts. And once it starts, it feeds on itself. Higher prices cause more people to want physical metal. More demand causes tighter supply. Tighter supply causes higher prices. It's a feedback loop that can run a lot further than anyone expects. We saw a taste of this during the Wall Street Bets silver squeeze attempt. For a brief moment, retail investors tried to buy physical silver en masse. And you know what happened? Dealers sold out. Premiums spiked. The system couldn't handle even that relatively small surge in demand. Now imagine that times 10, times 100. Imagine institutional money trying to get into physical silver. Imagine sovereign wealth funds. Imagine pension funds realizing they need hard asset exposure. The market is way too small to absorb that kind of demand, without prices going absolutely ballistic. And this is why I keep emphasizing physical. Because when that moment comes, the people holding paper silver are going to find out that their contracts can be settled in cash. They'll get paid out at whatever the spot price is, but they won't get metal. The people holding physical silver will be the ones who actually benefit from the shortage. They'll be the ones who can choose whether to sell or hold. They'll have the leverage. Think about it like this. If you own shares in a silver ETF, you own a claim on silver that the fund supposedly holds. But can you actually take delivery? Can you show up and say, "Give me my silver"? In most cases, no. You can sell your shares for cash, but you can't get the metal. And in a crisis, when everyone wants metal and nobody wants cash, that distinction becomes everything. This is why storage matters. This is why taking possession matters. Yes, it's less convenient than a brokerage account. Yes, you have to think about security, but that inconvenience is the price of actually owning something real. And in a world where so much wealth is just digital entries in a database, where so much value is based on promises and trust, having something physical is increasingly valuable. Let me paint you one more picture. Imagine it's a few years from now. The silver market has finally broken. Prices have gone vertical. There's a scramble for physical metal. You're sitting on a stack of silver coins you bought when everyone thought you were crazy. What are your options? You can sell some and take profits. You can hold and wait for even higher prices. You can trade it for other assets that have become cheap. You have options. You have flexibility. You have real wealth that you can deploy however you see fit. Compare that to someone who has all their wealth in a 401k invested in index funds. They're at the mercy of the market. They're at the mercy of their fund manager. They're at the mercy of the rules and regulations that govern retirement accounts. They can't just decide to take their money and do something different without penalties and restrictions. They're locked in. You're not. This is the freedom that physical assets provide. This is why, throughout history, in every major crisis, the people who survived and thrived were the ones who had tangible wealth. Land, precious metals, real assets that couldn't be inflated away or defaulted on. The people who had paper wealth, who had promises, they were the ones who got wiped out. Now, I'm not saying sell everything and buy silver. I'm not saying put your entire net worth into one asset. What I'm saying is that physical silver deserves a place in your wealth preservation strategy. It's insurance. It's a hedge. It's a way to protect a portion of your wealth from the risks that are building in the financial system. And unlike most insurance, this insurance has the potential to not just preserve wealth, but multiply it if things play out the way the fundamentals suggest they will. The question you have to ask yourself is this: what's the cost of being wrong? If you buy physical silver and nothing happens, you own a tangible asset that holds value. You're not ruined. But if you don't buy physical silver and everything I've described happens, if there's a currency crisis, if there's a silver shortage, if the paper market breaks down, what then? You're stuck holding assets that are denominated in currency that's collapsing. You're stuck trying to get into physical metal when everyone else is trying to do the same thing. You're late to the party and the price of admission has gone through the roof. That's the asymmetry I keep coming back to. The downside of owning physical silver is limited and manageable. The downside of not owning it when you should have is potentially catastrophic. And when you're thinking about protecting wealth you've spent decades accumulating, when you're thinking about your retirement, your family's security, your legacy, that asymmetry should matter to you. So here's what I want you to do. First, grab that free guide in the description. Educate yourself on how this works. Understand your options. Second, if you're serious about this, if you have 100,000 or more in retirement accounts, stick around until the end, because I'm going to tell you about something special. And third, start thinking about physical silver not as a speculation, not as a get-rich-quick scheme, but as a core part of your wealth preservation strategy. Because at the end of the day, this isn't about making a quick buck. This is about surviving what's coming. This is about having real wealth when paper wealth fails. This is about being on the right side of the greatest wealth transfer in history. And physical silver, boring old silver that everyone's ignored for years, might just be the ultimate escape hatch from a system that's running on borrowed time. The smart money knows this. The central banks know this. The question is, will you figure it out in time? Or will you be one of the people scrambling to get physical metal when it's already too late, when premiums are sky high, when dealers are sold out, when the only silver available is at prices that make today's levels look like the bargain of the century? The choice is yours, but the window is closing. Every day that passes, more industrial silver gets consumed and doesn't come back to market. Every day, more investors wake up to what's happening. Every day, the supply gets tighter and the risks get bigger. You can wait and see what happens. Or you can take action now while physical silver is still available at reasonable prices.